Well, welcome to another edition of the Rogers Capital Market Commentary, where we attempt to cut through the noise, the proverbial water cooler wisdom, and give you a clear, concise overview of what's been driving the financial markets, what we're watching closely, and even occasionally, like today, investing principles that can make you a better investor. And yes, if this ridiculous suit here and Christmas tree cufflinks aren't a signal to you already, yes, this is our December edition, our Merry Christmas edition of the Rogers Capital Update. Let's just take a quick look at the markets. With 2 weeks to go in 2025, the S&P is up 15%, the NASDAQ up 19%. A good year by any measure, especially given the February-March downturn. The Fed cut rates again this month, putting us at 3.5%, with more cuts expected in 2026. But this video, I thought I'd take some time to address one of the most important disciplines in professional investing. That is why we sell. Spoiler alert, there are times when we sell. Maybe you've been with a previous firm that didn't even believe in the word sell. When's the best time to invest? Today. When times are good, buy, buy, buy. When times are bad, what? Don't sell now. Things are on sale. They're 50% off. You buy more. There are, in fact, reasons to sell. Double spoiler alert. It's not because of cable news, mass marketed emails, market noise. It's because we follow a process. I'll break down the framework we use and then share real examples of how disciplined selling has worked for our clients in recent years. Now, it's infinitely more complex than this, but generally, here is the discipline of selling. The 5 things that would cause us to sell. Okay, number 1 is rebalancing. Portfolios drift over time. Winners grow and losers shrink. If a single stock or fund grows beyond 5 to 10% of the portfolio, then we trim it. This isn't punishment for that stock, it's risk control. It's what serious money does, okay? The concentration of an individual holding is the enemy of diversification. Number 2, valuation discipline. We set target ranges for valuation metrics. When a position trades well above fair value, we harvest gains. An example would be trimming big tech names after massive runs, even if the story is still strong. Third, risk management. We monitor sector weights, volatility, correlations of various investments. If one sector dominates, then we reduce exposure. We also monitor macroeconomic indicators. I don't have a crystal ball. I'm not a prophet. No one can predict planes flying into buildings or global pandemics. But there are big picture indicators that can signal the health of the economy, the investing climate, if you will. Like, for example, PMI, the manufacturing index, the yield curve, inflation, volatility, credit spreads, earnings. You've heard these terms over and over through the years. So, for example, right now, you can take a look at this graphic here. PMI is greater than 52. That means expansion. Yield curve is positive. The traditional positive slope of at least a quarter point. Okay, we're more than that. Core CPI is less than 2.5%. That means inflation is cooling. The VIX, the volatility index, is, if that's less than 15, calm markets. Credit spreads of less than 120 basis points mean a healthy credit market conditions, okay? An appetite for risk. And then positive earnings revisions, earnings that surprise to the positive, to the upside. And you can take a quick glance at kind of where we are today. Green lights, yellow lights, and then, of course, no red lights. Number 4, reason to sell, investment rationale. Every position is built on a clear, rational expectation or story. If earnings weaken, leadership falters, CEO leaves, et cetera, competitive edge erodes, then we reassess. Discipline means acting when the evidence changes, not just clinging to yesterday's story. And then number 5, client-centric needs. We don't do the same thing for everybody around here. You don't get the gold portfolio or the platinum portfolio. You get something tailored for you, your situation. That could mean liquidity for retirement, estate planning, tax harvesting. Sometimes we sell not because of markets, but because of life events. Now, those are the 5 sell disciplines. Notice what's missing. Fear, headlines, politics, panic. Those aren't reasons to sell. Here's some real-world examples putting some of these 5 things in action here. Moving away from bond funds, for example, pre-2022. In late 2021, yields were near historic lows. Inflation, though, was heating up. Bidenflation, you may remember, 9% year-over-year inflation. So we reduced exposure to those longer duration bond funds and shifted money into, many of you may remember, money market funds. You could get institutional money market for 5.25% and no downside risk. The disciplined interest rate risk management, protecting clients before the Fed's rate hikes hammered bond prices in 2022. Here's another example, trimming concentrated positions. We've had client portfolios had a single stock growing to more than 10% of their total assets. Even though the company was strong, we trimmed it back. The discipline there is rebalancing and concentration control. We can't have any single name jeopardizing the overall retirement security or comfort level. Example number 3, sector overweight adjustments. Tech and growth stocks boomed post-pandemic. We trimmed some of those positions after that to keep sector weights in line with our investment policy statement, and our targets. The discipline there, risk management, ensuring the diversification across all sectors. Here's a 4th example, harvesting gains for liquidity. A client recently needed funds for down payment, home purchase. So we sold some appreciated equities strategically to kind of minimize the tax impact, to provide those funds. The discipline, client needs come first, aligning our portfolio with life goals. So here's how I explain it to clients generally. We don't sell because the news is loud. We sell because the numbers or the plan tell us it's time. Those of you who are gardeners, do we uproot the garden because of a cloudy day? No. You prune and water based on the season so that it thrives. Or from the sports world, do coaches bench a player because of what those in the crowd are saying? No, they make changes when the stats or the situation demand it. Selling is an active, protective, disciplined strategy rather than a reaction. From exiting bond funds ahead of rate hikes to trimming positions or rebalancing sectors. Every decision is made to protect your capital, your overall portfolio, protect your plan, and ensure long-term growth. Well, that's it for this month. Closing thoughts. As always, my team and I are here for you. If this update sparked a question, if some of this sell discipline talk triggered something in your mind, if you'd just like to revisit your plan in light of recent volatility, let's schedule a quick check-in call. The fact that we do quarterly reviews doesn't mean we can't talk between those reviews, right? Thank you for your continued trust. Merry Christmas to you and yours, and wishing you a blessed and prosperous 2026. We will see you next time.